We asked our CNBC mock Fed how they would vote if they were calling the shots tomorrow. Out of our 7 economists, business owners, and market watchers, 4 went 50, 3 went 25. It's almost exactly like the market right now, evenly split. Our next guest is part of the latter group. He says the proverbial close call camp. Joining us for more is PIMCO chief economist Paul McCulley. Paul, so you're calling for 25? Welcome.
Yes, I am. I think 25 is the base case because I think it maximizes the Fed's optionality. If they go 25, they retain the option to speed up if you get a unexpected weakness in the labor market. In contrast, if they go 50, I think they are de facto locking in at least 2 more 50s, which would mean that if you get unexpected weakness, then you would put 75 on the table. So I think from a option-adjusted perspective, it makes sense to them to do 25. But note, I am not pounding the table on that because I also understand the argument. They have a long way to go. They're a long way from neutral. And there is a reasonable, sensible argument for starting with 50, but at the cost of giving up optionality, in my view.
So let's say they do go 50 or they go 25. Where do we end up a year and a half from now in terms of where interest rates are going to be? Because the Fed will almost certainly do many more, well, maybe not many, but several more cuts beyond what they're expected to do tomorrow.
Oh, I think many is the right word, Tyler. No question about that, which is why I think that we have to look at the 25-50 decision tomorrow in the context of the new dot plot. The last dot plot was back in June when they were only looking for 1 cut this year and then for a series of cuts down to a little over 4, call it 4 1/8 at the end of next year. So I think the big thing they'll be doing at this meeting is a serious whack to the dot plot. And I think that by the end of next year, we're thinking in terms of at least 200, if not a little more, and basically moving down to a 3 handle,
to roughly
maybe a 3.5.
Brent, you want to jump in?
Yeah, I do. So, Paul, my question to you is, why, if neutral is 3%, why should we go on a slow pace? Why shouldn't the Fed be more aggressive if we're truly imbalanced in terms of inflation and employment? Why shouldn't they be more aggressive?
I understand that argument. We always get that argument at the beginning of a cycle, whether it's a tightening cycle or an easing cycle. If you know you got to go a long way, why the hell don't you just go ahead and get there as quickly as possible? I understand that argument, but that's not how the institution tends to go because the world is uncertain. So essentially, incrementalism is the code at the Fed. And I think that from the standpoint of support for the economy, incrementalism is not all that negative of a thing because the capital markets are going to romance and discount the destination. So you can have both. You can have the capital markets reflecting a lot of the destination out the curve, while you can have the Fed moving in a careful, judicious, measured way in validating what the curve has already done.
Yeah, and they certainly have earned that credibility in terms of forecasting. There's no question about that. I would ask you the political question. Historically, the Fed has not acted so close to an election. And so does having the election so close and to have, I think it was 3 sitting U.S. senators yesterday to write a letter encouraging the Fed to move by 75 basis points, if you're sitting on the Fed Open Market Committee, does that have an impact on you?
I don't think it makes one damn difference whatsoever. I think that Jay Powell has said the truth, which is that he's going to make the decision based upon his best judgment. He may make a mistake, but he's going to do it on his best judgment of what the economy needs, and that he's not playing politics whatsoever. So I don't think the election matters a damn bit in the decision they make tomorrow.